In early February 2025, the trade relationship between the United States and Canada encountered an unprecedented challenge. Rising trade tensions were fueled by President Donald Trump's controversial decision to impose substantial tariffs on Canadian goods, citing concerns over illegal immigration and the growing fentanyl crisis. On February 4, 2025, Trump announced a 25% tariff on all Canadian imports, stating that Canada had failed to address border security issues, particularly the influx of fentanyl into the U.S. These tariffs aimed not only to address border concerns, but also to reshape North American trade dynamics. A specific 10% tariff was also placed on Canadian energy exports, directly impacting the country's vital oil and gas sector, which plays a crucial role in its economy. In response, Canadian Prime Minister Justin Trudeau swiftly introduced retaliatory measures. Canada imposed a 25% duty on $30 billion worth of U.S. goods, set to take effect the same day as Trump's tariffs. Trudeau also indicated that additional tariffs could be applied to $125 billion in U.S. imports, pending a 21-day consultation period. The targeted American products included a diverse range of items such as beer, wine, bourbon, fruit juices, clothing, sports equipment, and household appliances. However, following intense discussions between both leaders, a temporary reprieve was agreed upon. Both governments decided to delay the tariffs for 30 days, while Canada committed to strengthening border security. This included appointing a new fentanyl czar to oversee anti-trafficking efforts and collaborating with the U.S. on a joint strike force to combat illicit drug flows. Although this compromise prevented an immediate economic crisis, reactions within Canada remained mixed. Economists warned of the long-term consequences of these trade measures, considering the deep economic interdependence between the two nations. The U.S. and Canada share one of the world's most integrated trade relationships, with the exchange of goods and services valued at hundreds of billions of dollars annually. Any disruption to this relationship risked causing widespread ripple effects, including higher consumer prices, supply chain disruptions, and reduced market stability. One of the industries most affected was Canadian oil. Canada, the world's fourth largest oil producer, pumps approximately 5.76 million barrels daily as of 2023, with the U.S. historically being its largest market. However, rising trade tensions forced Canadian oil producers to seek alternative international markets, particularly in Asia. The Trans Mountain Pipeline, a crucial Canadian infrastructure project, played a central role in this shift. Completed in May 2024, the pipeline expanded its capacity to 890,000 barrels per day, nearly tripling its previous volume. This expansion provided a direct route to Asian markets, where demand for Canadian crude, especially in China, was rising. In late 2024, Chinese refiner Rongsheng Petrochemical secured multiple shipments of Canadian crude, underscoring China's growing appetite for heavy crude oil. This shift reflected Canada's broader strategy to diversify its oil export markets and reduce its reliance on the U.S. amid volatile trade relations. Canada's oil industry has seen significant growth, largely due to its vast oil sands reserves in Alberta. As of 2023, Canada ranked as the fourth largest oil producer globally, behind only Russia, Saudi Arabia, and the U.S. The country's oil sands, primarily located in Alberta, hold the third largest proven oil reserves in the world, with an estimated 180 billion barrels. In 2019, Canada produced an average of 4.7 million barrels per day, with 64% of that coming from unconventional oil sands production. By 2023, daily production had risen to 5.76 million barrels, solidifying Canada's role as a major energy supplier. However, the environmental impact of Canada's oil industry has sparked debate. Critics argue that ongoing investments in oil projects, such as the Trans Mountain Pipeline expansion, undermine Canada's climate commitments. The country has implemented policies like a nationwide carbon tax and set ambitious emissions reduction targets. Yet its continued fossil fuel expansion raises concerns about the balance between economic growth and environmental responsibility. This contradiction remains a key point of contention in Canadian politics. While tensions with the U.S. took center stage, Canada continued to strengthen trade relationships with other global partners, most notably China. China is Canada's second-largest trading partner, with bilateral trade reaching $25.4 billion in 2022. This growing relationship highlights Canada's efforts to diversify its export markets amid uncertainty with the US. In 2023, Canadian exports to China included a variety of commodities, with oilseeds and canola leading the way. Canola exports to China surged by 75.2% compared to the previous year, driven by China's post-pandemic recovery and increasing demand for agricultural products. Other key Canadian exports to China included iron ore, copper, coal, and wood pulp, essential for China's industrial growth. Despite this expanding trade relationship, Canada faces a persistent trade deficit with China. In 2023, Canadian imports from China reached $100 billion, a 16% increase from the previous year. This deficit has raised concerns about the sustainability of the trade partnership, but Canada continues to explore market diversification strategies to mitigate risks associated with over-reliance on any single country. Beyond economic concerns, the US-Canada trade tensions carried broader political and social ramifications. One immediate concern for Canada was the impact on consumers. With a 25% tariff imposed on a wide range of US goods, economists warned that Canadian households would see rising costs for everyday items, from clothing to household appliances. While the tariff on Canadian energy exports was smaller in percentage, it could still contribute to higher fuel prices, further straining household budgets. Industries reliant on US imports, particularly the automotive sector, also faced significant risks. Canada's automotive industry, primarily concentrated in Ontario and Quebec, is closely integrated with US manufacturers. The new tariffs threaten to disrupt supply chains, increase production costs, and potentially lead to job losses. Given that the US is the primary destination for Canadian automotive exports, prolonged trade disruptions could have long-term consequences for Canada's manufacturing sector. The trade dispute also placed political pressure on Prime Minister Justin Trudeau. Known for advocating multilateralism and strong US-Canada relations, Trudeau faced declining approval ratings amid the economic uncertainty. His decision to negotiate a delay in tariffs was viewed by some as a practical approach to avoid immediate economic fallout, but others criticized it as a sign of weakness under US pressure. At the same time, discussions emerged in Canada about reassessing its trade dependence on the US. Some political leaders proposed strengthening economic ties with other global powers, particularly China. These conversations raised questions about Canada's future foreign policy direction, with some advocating for a more diversified trade strategy to reduce reliance on the US. The geopolitical landscape also shifted as Canada navigated its relationship with the US against the backdrop of China's growing influence. The strengthening trade relationship between Canada and China has drawn concerns from Washington, where policymakers view China's expanding global reach as a potential threat. The Trump administration's remarks about Canada possibly becoming the 51st state could be interpreted as an attempt to pressure Canada into aligning more closely with US strategic interests, particularly amid escalating US-China tensions. China, on the other hand, remains eager to expand economic ties with Canada. Beyond purchasing Canadian oil and agricultural products, China has made substantial investments in Canadian real estate, mining, and technology sectors. These growing economic links create new opportunities, but also present challenges, as Canada must navigate the complexities of balancing relations between the US and China. Looking ahead, Canada's long-term strategy may involve further trade diversification, reducing its dependence on both the US and China. The recent shifts in global energy markets, with rising demand from Asia, provide an opportunity for Canada to expand its market reach beyond North America. The completion of the Trans Mountain Pipeline in May 2024 has been a key component of this effort, enabling direct access to Asian markets, particularly China. However, these diversification efforts must also align with Canada's climate commitments. The country has pledged to reduce greenhouse gas emissions, yet its expanding oil exports create contradictions in its environmental policies. Critics argue that prioritizing oil infrastructure over renewable energy undermines Canada's climate goals. The ongoing debate over economic growth versus environmental sustainability is expected to shape Canadian politics for years to come. As of February 2025, the US-Canada trade dispute remains unresolved. While negotiations continue, the core issues of fentanyl trafficking, border security, and trade imbalances persist. The outcome of these discussions will have significant implications for Canada's economic future and its role in the global economy. What do you think about the escalating trade tensions between the US and Canada? Do you believe Canada should diversify its trade partnerships further, or should it focus on strengthening its relationship with the US? How will these tariffs impact everyday consumers and businesses in both countries? Let us know your thoughts in the comments below.